All right. Welcome to the show, everyone.
Right, here we are. February 9th. Very good.
Just moving along, man.
Get it on. Who's playing this weekend?
Super Bowl something.
No. Rugby.
Oh, that's Scotland and by the time the show comes out, this has already happened. But Scotland and Ireland.
Ireland, that's what I thought.
Yeah. Oh, you got your Ireland shirt on.
I do. That's why I wore the shirt.
My Scotland shirt.
Yeah.
I didn't. I got a Scotland jersey, but it's so freaking heavy, like it's a
authentic.
No, their jerseys are like really tight.
Yeah,
I couldn't do that. But it's like a rugby jersey, like the big heavy ones.
Right.
Man, I'm like, it's too hot for that, even though it's like 40 degrees outside. But go Scotland.
Yep. And Super Bowl, going to be a big weekend.
Yeah, whatever.
It's because your team ain't in the game. That's
Same old team. Our guy got offensive rookie of the year, quarterback. That's I'm happy enough for that.
Right.
I'm not even a huge football fan, so you guys don't take that just take that lightly. It was the first time I've ever been to watch Washington football with any hope in 31 years.
Right.
You got to take it. But
they came close. Ish.
Hey, really close. All right, what you got for us this
week?
All
right. Another volatile week. And I use that term volatile all the time, and I finally gotten around to doing a piece on the podcast here that
what does he mean by that?
What exactly is volatility? Yeah. And the bond market, I keep talking about that too, that the bond market is really important, and we're going to kind of look at some of those details. But first, we'll do what happened this week, and then at the end, the TSP fund charts. So Monday, we had ISM Manufacturing PMI rose to 50.9. That's a pretty big deal. It's the first expansive reading in over 2 years. The ISM Manufacturing employment and new orders were all up, and prices were up. So when the price goes up for the manufacturers, it's inflationary, right? It means prices eventually are going to get more expensive for us. But manufacturing employment rose and new orders rose, so that's positive. S&P was down Monday 0.76%, but this is the PMI kind of drilled in. So this was the top in 2022, the top in manufacturing. So the S&P had rolled over, at the very beginning of 22. Manufacturing rolled over a little bit later, but anything above 50 means the economy is expanding in terms of manufacturing, because it's the manufacturing side and the services side, right? So manufacturing had been tanking, and it got below 50 in September, October of 2022. And this whole section in here, a lot of economists refer to it as a manufacturing recession. So even though we didn't officially get a recession, you can see that we were below that 50 line for a long time, from September, October of 22 until this month. We just got above it, and it's 50.9. So that's good. Manufacturing is coming out of this manufacturing recession. It's very positive. Okay, Tuesday, the JOLTS job opening labor, it's a survey. It comes in at 7.6 million versus 8 million expected job losses, right? So the labor market is cooling. S&P was up 0.72% on Tuesday. And on Wednesday, I'm sure this was a big relief for a lot of people that were trying to get a mortgage. The 30-year mortgage rate dropped below 6.97% from 7.02 last week, and applications ticked up a little bit. They were up 2.2%. So maybe some stability in the housing market. Who knows? S&P 500 was up 0.39%. And on Thursday, initial jobless claims come in at 219,000 versus 208,000 last week. So a decent uptick in initial jobless claims. The forecast was for 215,000, so it was definitely above expectations. Continuing claims were also up. So initial jobless claims makes you wonder. All these stats, they don't all. Sometimes they conflict each other. Sometimes seemingly the same things conflict each other. So we had initial jobless claims on Thursday increasing, And then on Friday, you get non-farm payrolls decreasing. So you get on Thursday, people that more than expected are losing their jobs. And on Friday, you have fewer jobs being created than were forecast. So you get 143,000 non-farm payroll jobs created versus the 170,000 forecast. But unemployment fell from 4.1 to 4.0. So the numbers make you scratch your head sometimes, that's all I can say. But the S&P, at least it's about 11.15 right now. When I looked at it at 11 o'clock this morning, S&P was down about 0.7. So another volatile week. Volatile, what does that mean exactly? So volatility is a measure of the dispersion of returns for a given security or market index, right? It's referred to from either the standard deviation or the variance between returns. So in most cases, the higher the volatility, the riskier the security or the fund in our case. And this is a definition from Investopedia. In the securities market, volatility is often associated with big price swings, either up or down. That's really the bottom line. It doesn't mean prices are falling. It means prices are capable of making big swings in both directions. So for example, when the stock market rises and falls more than 1% over a sustained period of time, it's generally referred to as a volatile market, right? Because we've seen a lot of that in the past since the December high. So volatility often refers to the amount of uncertainty or risk related to the size of changes in a security or the fund's value. It just means we got big, wide swings. Higher volatility means that the security's value can potentially be spread out over a longer or a larger range of values. This means that the price of the security can move dramatically over a short period in either direction. Lower volatility means that security's value does not fluctuate dramatically and tends to be steadier. So a lot of people use the VIX to kind of measure volatility. It's not the only way to do it, but it's probably the most common way. So market volatility can also be seen through the volatility index, which is the VIX, a numeric measure of equity market volatility. So the Chicago Board of Options Exchange created the VIX, and it's a measure to gauge the 30-day expected volatility of the S&P 500. Right? It's derived from quotes of put and call options. So it's effectively a gauge of future bets that investors and traders are making on the direction of the markets or individual securities. A high reading in the VIX implies a risky market. Traders can use the VIX, a variety of things, options, exchange traded funds. You can buy the VIX. You could buy a short VIX. If you get good at looking at that chart, it swings quite a bit, and people can make a truckload of money with it. So here's what the VIX kind of looks like. This is the VIX. It's a daily chart, and this is the S&P 500. Okay. So this is the easy one. When stocks collapse really fast, the VIX spikes, right? That was COVID. They call the VIX the fear index, and it works in both directions, but generally people refer to it. It tends to spike when price falls a lot. It doesn't tend to spike when price goes up a lot. When the VIX, they call it crushing the VIX. When the VIX starts coming down really fast is when stocks go up really fast. So the best way for us to use it is you can see as price is going up into that peak in 2022, the VIX had already bottomed and it started to turn up, right, at the peak. You got higher highs and you're starting to get higher lows. So the trend in the VIX is trending higher. And when the VIX goes up, the S&P goes down. And it works the other way too, right? In terms of the trend. When you start getting lower lows and lower highs, the VIX is stabilizing and the S&P goes up. Most of the time, the VIX is down here, really little moves like this, and the market goes up. So where we are right now, kind of in terms of the VIX, if you drew that trend line, it's trending up. I mean, if the VIX gets down below 15, right? If it gets below these lows, price keeps moving higher, no doubt. But right now we have an upsloping bottoms, but we have, lower highs. So it's kind of inconclusive right now. We don't have a really good, we don't have this kind of thing forming. So if the VIX kept moving higher, if the lows kept moving higher, that would be a bad indication for the S&P 500. But for our purposes, like whenever I talk about it all the time in the newsletter, in the email, this week is another volatile week, right? But what it means is price is swinging a lot in both directions, and that is really frustrating if you're looking at percent moves one way or the other on a day-for-day basis. If the VIX is high, if the VIX is like 20, you need to expect that price is going to jump around a lot. The trend, it doesn't affect the trend, but it affects the day-to-day movement of price.
Right. I think that's a key thing to remember, right, when we're talking about volatility. Volatility doesn't necessarily impact the trend per se.
Right.
It just impacts the volatility during the trend. Right now, the trend is sideways,
right,
and it's a volatile sideways.
Right.
It's not kind of a chill out and happy sideways.
No, it's volatile.
It's all over the place.
Yeah.
I was just looking at it while you were going through that, and it's just like it's a perfect example. Maybe we could take a look when you get to the charts. But yeah, this is the most volatile sideways movement, extended sideways movement I can remember seeing it in a while.
For a minute, yeah.
Usually you can zoom out and see it, right?
Yeah. In hindsight, you can see it.
In hindsight, you can zoom out and go. Right now, you're looking at it while it's happening.
Yep.
It's probably one of the most confirmed range-bound markets I can recall for a good while.
And it's really hard, right? Because the range is relatively wide. Not really in the big scheme of things. It's not. But say it's 5 or 6, 7%.
It is for the S&P.
Yeah.
It isn't for like a normal stock.
Right.
But
so say it's like 5 or 6, 7% or whatever. When you get to the bottom of the range, and you start having big volatile up days, we are up, 1.5, 2.5. Like you look at that and go, why am I not in the stock funds? Right. And then as soon as it gets to the top of the range, it equally rolls back down on the same, big percentage moves down. So until it breaks through that range one way or the other, it's just frustration. I mean, I would write it out in the G fund and not worry about it.
Yeah, but if you're in a brokerage account or something where you can move in and out every day, you're an IRA. It's a whole different game. We're talking TSP, folks, where we cannot do that. Anything close to that. No. So that this volatility, all within a, like let's just say plus or minus, 10, it's a 10% range, because there's a couple times where it went outside top and bottom.
Yep.
So you could widen that range a little bit. It's probably shrunk down to around 6 or 7, but anyway, that's just a lot of swings that you can't work with in the TSP.
No, you're just fully guessing.
Yeah, absolutely.
So, right. What is the bond market telling us, right? What does it mean for the stock funds when the F fund goes up? So the F fund moves higher when interest rates fall. Okay. All bonds, the price of the bond goes up when the yield on the bond goes down. And yield and interest rate is the same thing. So how does falling interest rates affect the stock funds? Okay. It depends on how rates are falling. In the first and most of the time, interest rates, when they're going down, it's a slow, steady decline. Okay, and that's generally bullish for stocks, for the TSP or individual stocks. Companies have cheaper borrowing costs, and the Fed is pumping liquidity into the system. When the Fed is lowering rates at a steady pace. It doesn't have to be the Fed lowering rates. It can be the bond market, lowering the market, bringing the rates down. But either way, if it's kind of a slow and steady decline, it's positive for stocks. So in this scenario, because rates are coming down, the price of the bond, the F fund, is going up. But so are the stock funds. So that's when you see the F fund and the stock funds going up together. The second one is when interest rates collapse because of a flight to safety. So if stocks are tanking because we have some kind of crisis or whatever it is, if stocks are tanking, then rates tend to collapse, and the price of the bonds spikes. So that's when we have the F fund going much higher really quick as stocks are collapsing. Okay, so sometimes you can have in the normal kind of a normal market, you can definitely have periods where rates are coming down, F funds going up, and the stock funds are going up. But in certain times, when you have a flight to safety, rates are coming down in a hurry. Stocks are also coming down, so rates are coming down, so the F fund is going up. So what does that actually look like? So in this one, I just went back to June of 2020. Okay, there are plenty of times. So this is the S&P 500, and this is the 10-year yield. Okay, there are plenty of times when yield is going up, right, and the stock funds are going up. Okay, so if yield is going up, the F fund is going down, and the stock funds can be going up during that time. One of two things happens. If yield rolls over, the stock funds go up. Okay, that basically always happens. When yield is coming down, like we said in the first, I'm a little bit locked up here. Let me try this again. You can see my computer still, right?
Yeah. Yep. Little technical difficulties with the chart. We'll just let him reboot it, and we'll just chat for a second.
Chat for a second there. I don't know what the problem is.
Yeah, it's always interesting with the way bond prices work in relation to the index. Is used to you could count on this kind of like 60-40 kind of thought process where like you did that because generally speaking, 60 being 60% of your portfolio in stocks, 40% of the portfolio in bonds. And the idea being when stocks were going down, you were offsetting a little bit of those losses by the bonds. And that doesn't quite hold up anymore.
It hasn't since the top in 2022.
Yeah, which is a long time. I mean, if you look back, it doesn't seem like 22 was that long ago. But, that's 3 years straight of like, it's not working out. So that tells you either, well, I think if we get past like 5 years, something has drastically changed in the way the markets work. Or this is kind of one of those things where, 3 years sounds like a long time. But when you start to bring it back out, you're like, okay, that was just a little blip there, for whatever economic reasons. Yep. I'm kind of hoping we get back to normal in some of these cases, but I don't see it happening.
Well, I mean, a lot of people understand this. I don't know, and we talk about it quite a bit, but it's really one of the biggest things you can kind of keep in the back of your mind. Interest rates peaked in the late 1980s, and so they spent the last 40 years declining, and it got to virtually zero.
Pretty much zero, yeah.
And so if rates are zero, assuming they can't go negative.
Right. And when is the last time that happened? The rates
in the United States, it's a zero. Like never. This is the lowest rates have ever been in like the history, like 1,000 years or whatever.
That's exactly what I'm getting at. Yeah.
Seriously, like 1,000 years.
Yeah.
There are people that track that stuff. Which means that bonds, right? The F fund is at an historic high. When yields get to zero, it can't go any higher, right? Because yields are price is inverse to yield. So if yields are zero, price is as high as it can get. It took 40 years to get there. From when the Fed started raising rates in 2021 or 22, whatever it was, and when rates went up to 5%, 10-year yield went up to 5%. That was the biggest move in interest rates ever. If you look, we've shown those charts before, but it's the biggest on a percentage basis. It's the biggest move ever. So ordinarily, that would force a recession and force the market to roll over and all that, and it didn't. But there are a lot of people that are calling it a lag effect, that eventually it is going to catch up and the market's going to have to roll over. But what the point is, it's unprecedented. The stuff that's happening in the bond market is unprecedented. And so one way of looking at it is we just had one of the worst bear markets in the history of bonds. Which of course you would, because you're starting from the absolute highest possible point you can be. You're at zero.
Yeah, all the fixed income people are finding it very difficult nowadays to try to maintain their jobs and maintain their, if you're an analyst, you're okay, right? But if you're making a living off the bond market, man, that's tough.
It's very hard.
All right, back to the charts now.
So
we got you running.
So here we go. Every time yield, right, rates start to come down, stocks go up. Okay, rates come down, stocks go up. Rates come down, stocks go up. Every time, pen's being goofy. Every time yield goes down, stocks go up. Okay. So when is that not the case? All I did was move the chart over a few months to give us a look at COVID. Okay. Rates come down, stocks go up. You can have rates go up and stocks go up, but here you got rates collapsing and stocks collapsing, which means the F fund is exploding to the upside. Okay. You don't see it very often. You got it back. So this was COVID. We had it in 2018 for a few months, right? We had a peak in yield. And yield started falling, which most of the time it means what? Stocks go up. But in this case, we were having the taper tantrum, and the back half of 2018 was very difficult. Stocks were collapsing. Yield is coming down, which means the F fund, people are fleeing to the safety of the F fund. F fund's going up. And the biggest example probably was 2008, right? You got this long period of time in here where yield is just collapsing. And so the stock funds are absolutely collapsing. So when yield is collapsing like this, the F fund is going up. The F fund can be a great tool. It just doesn't happen all that often. All right, so if we go back to where we are right now, a lot of the time, when you get a peak in yield, it tends to be a bottom in stocks, right? All these peaks tend to correspond to some kind of bottom in stocks. So what's interesting right now is we are, is that a peak? It is a peak, right? Because we're below it at this point. So is that a peak? Yes. And do we have a low, in stocks? Yeah, we came off a little bit off the highs right there. If you draw that trend line and rates continue higher, right, eventually, as rates go up, it puts more and more pressure on stocks and stocks roll over. But if this is a real peak in rates, a lot of people think rates are going lower from here. So if rates come down, the stock market keeps going up, because every time you get to a peak in rates, it's a low for stocks. And when rates fall in that environment, stocks go up. So either, if you're just watching rates, which is a good one to watch, either rates go up and eventually stocks come down because they're getting too much pressure. It's too expensive. Rates are too high. Or rates start falling and the stock market is falling. And then the F fund is exploding to the upside, because this is a fear trade right here. So as long as rates, can continue in this direction that they're going, stocks can continue higher. So it's one of those three possibilities is happening. And a lot of it is going to come to a head if and when we butt up against 5% again on interest rates. Okay, TSP fund charts. So this is a weekly chart of the C fund. This is the 20-week moving average line in blue and the relative strength index down here. Relative strength is one of the best things to track. As long as you're above that 50 line, price is going up. When you're below that 50 line, price is going down. It's pretty much that simple. It doesn't have to be that much more complicated. Sometimes we get divergence. We talk about that all the time. Divergence is when you can see in relative strength that the underlying momentum of the price movement is weakening. So you got weakening momentum here, even though price is continuing higher. Okay. You did not get any kind of, in this decline right here last summer, it was the same in relative strength. So we didn't get any kind of early warning about it. Right now, we definitely have weakening relative strength. And we're in this sideways channel. It's a little bit hard to see on the weekly, but that's the sideways channel we're in. And we're in it in weakening relative strength. So it doesn't mean the market has to roll over here, but the risk is higher than it would be if relative strength was, up here somewhere. S-Fund, same kind of idea. This is the 20-week moving average line. It's found support. It's more volatile. Doesn't respect that line as much as the C-Fund does, but pretty much finds support at that 20-week and keeps on going. And that was the last support level we had right there. S-Fund is not gonna. It's down today a little bit, so I don't know if it finishes up, 0.6 for the week, but we're still pretty far off the high back here from December. iFund is kind of interesting. It's been kind of hurting here since its top in September last year. And then 2 weeks ago, finally got back above that 20-week moving average line, and a pretty strong week this week. And we finally got back above 50 on relative strength. So if the dollar continues down, the iFund continues up. And F-Fund, same thing. If we had the same, the F-Fund and the iFund charts have been pretty similar here for the last several months, but F-Fund back above its 20-week moving average line, relative strength above 50. So it's kind of going to what we were talking about. If the stock funds tank, is the bond market kind of sniffing out a problem in the stock market right now? You still got that downsloping trend line. So if we get outside of that line, especially if we do it quickly, the stocks are tanking and the F funds exploding to the upside. Not there yet. Don't know that we have to see it before it actually happens, but it's certainly a possibility. And if you don't want to mess with any of it, you're hanging out in the G fund that keeps going up and to the right. Questions?
Right. If you have any questions, you can always put them in the comment section wherever you find the video. If there's no comment section, shoot us an email, support@growmytsp.com. Hit the like button if you're on YouTube. Give us a little love.
Yep, subscribe. And all that. Supposedly it helps the algorithm.
It does. We never ask people to do that, but I kind of hope you guys are. Share it with your friends, and share it with your enemies too.
Yeah, they might like their TSP.
All right, whoever you're supporting in the Super Bowl, hopefully they win for you. We'll talk to you guys later. Have a great week.
Out of here.